welcome to my YouTube channel at Illumination Hub NG. Don't forget to subscribe to the YouTube channel and also click on the notification bell so that you can be notified whenever I drop a new video. Today we are going to be looking at Interlocking Accounting System. We're going to just quickly go through briefly the meaning of Interlocking Accounting System, some reasons why we have a disparity in the cost accounting profit as well as the financial accounting profit. And also we're going to look at a typical question, as you can see on the screen, on how to reconcile the financial account profit as well as the cost account profit. Okay, so let us quickly jump into the video and also um, see how we can solve this question. So when we talk about interlocking accounting system, we will talk about interlocking accounting system, interlocking accounting system. Now, the interlocking accounting system is just a system of accounting where we have the cost account is prepared separately, and the financial account, financial account is also prepared separately, thereby resulting into differences in profit, which is further subjected to reconciliation. So the essence is for us to be able to reconcile our cost account profit and the financial account profit. Okay, so what are the reasons behind the differences in cost accounting profit and the financial accounting profit? One of the things that we need to understand for the reasons, okay, reasons for differences, okay, differences is the number one. We have valuation of stock. Okay, under the cost accounting, stock valuation is done based on first in, first out, comma, weighted average, and last in, first out. Okay, and under the financial account, okay, cost of stock or inventory is valued based on the provision of IAS 2 on inventory. Okay, that says that we should what? We should not adopt the use of last in, first out for valuation. Also, the cost of inventory is valued based on the lower according to IS2, lower of costs and cost and cost and net realizable value. Realizable value, known as NRV. So we have what? Valuation of cost of inventory based on the lower of cost of closing inventory and the net realizable value on the cost. Okay, so the lower of both we're going to what select based on the provision of IAS2 on valuation of stock. Okay, so the second one is has to do with appropriation. Appropriation. The second one is on number two. Appropriation. Appropriation of profit. So when we're talking about appropriation of profit, we're talking about the distribution of profit, okay, to the various stakeholders of the organization based on their contribution, okay, to the finances, okay, of that organization. For example, in the case of partnership, okay, so we appropriate to a share of profit. Share of profit will cause a difference, okay, between the CA profit and the FA profit, okay. We have um dividend dividend paid or proposed. So dividend paid or proposed, we also have what? An effect on the profit, okay? And also we have corporate tax. Corporate tax. Okay, tax paid will also have an effect on the profit, okay? Preliminary expenses. Preliminary expenses will also have an effect on the profit declared, okay? So we also have transfer to reserves. Transfer to reserves. This also have what? Cause a difference in the P in the financial accounting profit and the cost accounting profit. We also have interest. Interest paid on debenture. Paid on debenture. This also affects what? The profit on the account. Okay, account profit. We also have salaries declared. Okay, declared to employees, because this will also will be taken out of the profit of the organization and so on and so forth. Okay, we also have three other incomes. Other incomes, and that will not be accounted for by the cost accountant. Cost accountant. Okay, accountant. There we have investment income. Investment income. Okay, we have dividend received. Received. We have commission received. We have discount received. Okay, we also have rent receivable or rent received, rent received, etc. So all these items we also have an effect on the profit declared by the financial accounting accountant or the financial accounting compared to what to the cost account profit being declared. Okay, so we also have items in the cost account not recognized in the financial account account. Okay, so all these and others are going to what result into the difference in profit, okay, recognized both in the financial account and the cost account. Okay, so this is just a summary of some of the things that you need to understand when you are preparing your reconciliation of profit. Okay, so you need to understand that there are some items that will increase the profit, while there are some items that will reduce the profit. Okay, it's either that we add back or we do reduce back, we reduce this item from the financial accounting profit. So let us just try to solve this task. Let's try to solve this task. Okay, so let me just clear this off. So let's solve this task that we have on the screen. So we're going to look at the question Antikeni Nigeria Limited. Antikeni Nigeria Limited. Antikeni Nigeria Limited's income statement for the period ended 31st of January 2020, okay, was as follows. We have purchases, okay, 150,000 being prepared. We have add, okay, closing stock. We add closing stock. So before, no, sorry, we less or reduce closing stock. Now, before we begin to do these things, okay, so let us just first try to understand the principle behind the provision or preparation of the income statement, okay, which will guide individuals on how to recognize the transactions to either add or subtract from the various profit recognized. Okay, so let's just see what we can do. Let me just delete these ones off and let us do some workings. Okay, so let's get back into the working. So we have reconciliation reconciliation of the the financial account profits with the cost account profits. So let's just do that. So for the beginning, let's start with the financial accounting profits account profits. So the profit here is 76035. Okay, now 76035. So let us just say add items, okay? Items to add, and let us just put it here. Deduct items to deduct, okay? Deduct. So let me just also clean this off. So we're going to have our workings here. Our workings. Our workings. Workings, okay? So for the first one, we get told that the closing stock was valued at 27,840. Okay. So the closing stock now number one, note one, the closing stock. So for financial accounting and cost accounting, so the closing stock of FA was, so let's look at the closing stock for FA is 12,750, as we can see here, 12,750. And the closing stock for cost accounting is 27840. Okay. So we have 12,750. And we have 27840. Okay. So what we are saying here is that there's a difference. Okay. The FA closing stock, okay, which is deducted, okay, reduced, okay, from the financial accounting, okay, is lower compared to what the cost accounting closing stock, okay, that was what recognized, okay, okay, on the cost accounting transaction, okay. So the closing stock was valued at 27840, meaning that what is the difference? The closing stock for FA is lower. The closing stock of FA is lower to the tune of, let's look at the difference. That is 12, that is 27840 minus 12,750. So when we have a high closing stock, this means our cost of goods sold will be higher. Okay. So a high cost of goods sold, okay, we reduce our profit. A high cost of goods sold because we have sales, less cost of sales. So when we have a high cost of sales, our profit is going to reduce. Okay, so we have 27840 minus 12750. This will give us 27840 minus 12750. So let us do the calculation. So let's do the calculation. So 27840 minus 27840 minus 12750. So this will give us 15090. 15090. So since we have only recognized a lower figure, okay, of closing stock in the financial accounting, okay, meaning that we have to reduce the profit, okay, furthermore by 15,090 naira. Reduce the profit furthermore by 15,090 naira. So when we have the difference in closing stock, okay, now this will be what will be added back to the financial accounting profits. So it will be added back because we have only recognized a lower cost closing stock value in the cost accounting, and we have only recognized what 12,750 in the closing stock of what of the financial account. Okay, so in this case, the difference between the two will be added back to the what financial accounting profit. Now, let me just quickly give this example to be able to prove what we have said here. Okay, so we have, let's assume that we have our income statement here. Okay, we have our opening stock. Okay, we have add purchases. Okay, this cost of goods available for sale. We now say less closing stock. Less closing stock. Okay, we're going to have our cost of goods sold. Okay, so in case we have our, let's assume that we have our sales here, sales figure. Okay, now our profits, our profits is the difference between the cost of goods sold and the sales. Okay, which will give us this. Now let us now check the principle that guides this transaction. So let's assume that from what we have here for the FA now, let's assume that we have an opening stock of um okay, let's have what we are, let's see the transaction again. Let's assume that we have the opening stock of 10,000. Okay, we have purchases of 5,000 for both FA and CA. Okay, our cost of goods available for sale is 15,000. Okay, okay. So our closing stock, let me use the transaction that we have here. Let me use the transaction that we have in the question so that we can explain this better. So in the question, we have opening stock or we don't have opening stock. Let's check that. There's no opening stock in this question. Okay, there's no opening stock in this question. But what I'm trying to say is that let's just prove something here. Let's assume that our opening stock here is 100,000. 100,000. Okay, and our purchases is about 20,000. Okay, our cost of goods available for sale will be 120,000. So when our closing stock, okay, is 12,750 now. Let's assume it's 12,750 from what we have picked here from this figure in FE. Our cost of goods, that's we are going to less closing stock. Our cost of goods for sale will be what? Will be 0, 0, 5, 2, 7, 0, 1. So 107,250, that's our what? Our closing cost of goods sold. But now let's just apply the same information and adopt this CA information. So again, we have, this is for FA. Let's assume this is for CA. Okay, we have 100,000 Abby as the opening stock. In this case, we have 20,000 naira as the purchases. Add our cost of goods sold is 120. Cost of goods available for sale is 120,000. We less closing stock of what? Our closing stock is 27,840. So let us see what happens to the cost of goods sold. 7,840. Okay, so we have what? We have 0, 6, 1. We have 2. We have 9. Okay, 92, then 92,160. So what happens to cost of goods sold? Okay, when our closing stock was lower, our cost of goods sold was high. Then also, and when our closing stock was higher here, our cost of goods sold was lower. So when our cost of goods sold is lower, what will happen to profit? Profit will what? Will further increase. Now let us assume that we sold an item, the item that we sold was 150,000. So when we adopt this 92,160, our profit will be what? Is 0, 4, 10, that is 8, this is 7, and this is 5. So we have 57,840. Now let us assume that we are now adopting the FA profit of 107,250. So our profit will be what? 0, 5, 7. We have 2. We have what? We have that's 9. We have 4. 4. So when our cost of sales was higher, we have lower profit. When our cost of sales was higher, we have lower profit. Okay. And when our cost of sale was lower, we have higher profit. Okay. The same applies to this. When our closing stock was lower here, is that not so? We have what? We have lower profit. And when our closing stock was higher here, we have higher profit. So it means that what we have understated our profit here due to what? A lower figure. Okay. So when we have lower closing stock, our profit was lower at for 2,715 naira, as you can see here. And when our closing stock was higher, as you can see here, our profit was higher. So in this case, based on what we have here, we have to add back this value of closing stock so that we can have our profit back to the value of what of the profit in the cost account. So we're going to add back this difference in closing stock so that we can balance up and have the same profit figure. Okay, so let us add now. Add difference in closing stock. So we're going to add difference in closing stock. Okay, that is 15,090 naira and 90 naira. Okay, so the second one, we have depreciation value was by the cost accountant at 3,540. Okay, so let us go to workings. Number 2, note 2. This is note 1. Please let's take notes. This is note 1. Okay, so we have our depreciation now. Depreciation. Okay, so for depreciation, so under depreciation for FA and for CA. So the depreciation for CA was 3,540. Okay, and the depreciation for FA was 4,915, as we have here. 4,915. Okay, 4,915. So the difference equals to 4,915 minus 3,540. We have 5. We have 6. We have 3. We have 1. So we have 7, not 6. It is 7. So we have 1,375 as the difference between the two. Okay. So we can see that in our FA, we are charging a very high depreciation compared to that in the CA of 3,540. Okay. Meaning that what we have to add this back to the what to the profit of the FA so that we can have the same profit figure for both the FA and the CA. Since we are charging more for depreciation on the profit and the fee on the FA, we are charging less, okay, on the CA. So in this case, we have to add back the difference between the FA and the CA to the profit on the financial account. So let us go back. So we add back, let's call this difference between depreciation. So we add back, this is note 2, we add back 1,370. If I'm right, 1,375, okay. 1,375. We add it back. 1,375. So the next one, we were told that the selling as well as the administrative costs were both valued at 10% of sales value and 0.24 per unit of sales in cost account. So let us go ahead now and solve for note 3. Note 3. So let's put that here. Note 3. Note 3. Selling and admin expense. Selling and admin expense. Okay. So for selling and admin expense, we were told that the selling expense should be 10% of sales value. So what's our sales value is 281,250. That's 10%. So for the FA and CA. So FA is 10%. So the CA is 10%. That will be 10% of 28. Let's look at that again. 1250. 281250. Okay. 281250. This will give us 28,125. Okay. And we have, let me just cancel this. We have the FA as 16,650 naira. Okay. Yeah. So it means that our difference will be 28125 minus 16650. That is will give us 28125 28. So let me do that. Let me use the calculator. 28125. So we have 28125. So let's do that. 28125 minus 16650. That will give us 11,475. Now, in our selling expenses, okay, we deducted an amount lower, okay, than the cost account depreciation of a difference of 11,475, okay, meaning that our profit for the FA will be higher because we have charged selling cost at a lower value compared to the cost accounting selling cost. In this case, we're going to deduct this 11,475 in the financial accounting profit from the financial accounting profit, okay? Because we have what? We have charged more in the cost accounting compared to what the financial account, okay? So we have a difference of 11,475 that we are going to deduct from the financial account profit. So let us go back and do that. So let's go back 11,475. So we deduct difference in that's the selling cost. Okay, so let me just clean this off. This explanation off. Let me clean that off. So we have it. Let's take this off. So we have the difference in selling cost. Now this one selling cost as 11, 11,000. Let's see the figure. 11,475. Okay. 11,475. 475. Okay. So let's look at the next one, which is admin expense. Admin. We have admin expense. Admin. Admin expenses. Okay. Admin expenses. For FA, financial account, and for cost account. We were told that the admin expense, we were told that the admin expense in this note 3 should be what? 0.24 per unit of sales in cost account. So 0.24 per unit. And we have sales of 75,000 units. So let's do that. Let's do the math. That will be 75,000. 75,000 units multiplied by 0.24 kobo. So that will give us 75,000 multiplied by 0.24 kobo. That will give us 18,000. 18,000. So our admin expense in the financial account is 13,580. 13,580. So this shows that what we have under, charge expenses 13,580 in the FA compared to what? Compared to the 18,000. So the difference between the two, the difference is 0, 2, 4, and we have 4. So the difference between the two is 4,420 naira, which we are going to what further deduct from the profit or in the financial account, because in the cost account we have charged more as admin expense, which we've now charged lower in the financial account profit, or the profit of the financial account. So we are going to what further deduct 4,420 as admin expense in the financial account profit. Okay, so let's go ahead and do that. So we have 4,420, 4,420. That is difference in admin cost. Okay. The next one, that one has been solved. The next one is production expenses were valued by the cost accountant as 5090. Let's look at the production expenses. The next note, this is note, okay, 3. The next note, note 4, production cost in the FA and in the cost account. So what do we have as production cost in the cost account is 5,090 naira. So 5,090 naira. That's 5,090 naira. 90 naira. So in the FA, what do we have there? In the financial account, what do we have in the financial account? We have the production expense as 9,720, as you can see here. 9,720. 9,720. Okay. So we have 9,720. So the difference is 0, 3, 2, 3. This is 12. This should be 6. So this should be 6. 12. This should be 6. And this should be 4. So we have 4,630. Okay. 4,630 as the difference. So what we are saying is that in this case, for production cost, we charge more compared to what? Compared to the 5,019 naira charge in the cost account. Meaning that we have reduced our profit and loss, our financial accounting profits more compared to what? Compared to the what? The cost accounting profit. So we have to add back. We add back this balance of 4,630 to the financial accounting profit. Okay. So let's add that back to the profit. We add back difference, difference, difference in production cost. Production cost. That's 4,000. Let's see the figure. 4,630 or so. 4,630. Okay. 4,630. 4,630. This is note 5. This is note 4. And this is note 3. Okay. So let's move on. So this is note 3, note 3, note 4. So note 3, note 3, and this is note 4. Note 4. Okay, please, that's note 4. So do we have any other information in the account that we need to consider? So we have direct wages, 42350. Direct wages of 42350. So we don't have any information here in regards to direct wages, okay? We do not have any information here in regards to direct wages, okay? So now let's look at the discount received. Let's look at discount received. So the discount received of 25 and investment income of 16,750 were recognized in the FA, but they were not recognized in the what? In the cost account. So we have to what? We have to, because this figure have further increased our profit, okay? We have to what? We have to deduct this figure back from the financial accounting profit. So let us deduct that from the FA. Difference in income, other income. Difference is in, we deduct it from the financial account profit, other income. So under the other incomes, let's just do the workings here, working 6. Other incomes. We have investment income and what? We have discount received. Discount received of 25. We also have investment income. Investment income of 16,750. So we have 0, 5, 12, 19,250. So in this case, we're going to add back, we're going to deduct the 19,250 from our profit, okay, so as to make it what? Reconcile with, this is note 5, not note 6, note 5, okay, this is 5. So that is 19,250. 250. So we have 19,250 as our other income in the account. So we have this information now being what? Being highlighted here after we have done the various adjustments. Okay, now let us now add up. Let's add up what we have here. Add this. The total figure that we have here is 15,090. 15,090 plus 1375. Okay, plus 4630. That will give us 21,095. 21,095. So we have 10, 12, 3, 1, 7, 9, 7. So let's add this together to and deduct. Deduct, okay? Deduct, we add. So we have 11,475. 11,475 plus 4,420 plus 19,280. We have 35,175. Okay. So what's the difference between the two? So 97 minus 97,130. 97,130. So 97,130 minus 35,175. Okay. Let's look at that. 35,145. 11,475. 19 to, okay, this is a mistake. I thought this is 80. This will be 250. Okay. So this should now be 35,145, not 7. 35,145. Okay, please. This is 19,250. Okay. So let me just do the calculation again. That is 97, 97, 97, 130, 97, 130 minus 35, 145. So we have 61,985. This is the balance. This is the closing stock profit. Sorry, the cost accounting profit, please. The cost accounting account profit. So you can see that at the end of the day, this is 1985 is equal to this. Please take note, okay? You can see that at the end of the day, we're able to reconcile the differences between the accounts. We're able to reconcile the difference between the cost account profit and the financial accounting profit, okay? At the end of the day, we have the cost balance in regards to what? The cost accounting profit of 61985. And we're able to identify the differences. Now, we may be asked that why is it that we did not recognize direct wages? Because direct wages, nothing was discussed about direct wages in the information that we have here in regards to the cost accounting profit. Okay, this means that what both direct wages and what and that in that of the financial accounting profit and the cost accounting profit are the same. So if there's any issue in regards to the direct wages, this would have been stated in this information or notes that we have here. So on this note, this is how to reconcile under interlocking accounting system to reconcile the profit in the financial account and the profit in the cost account. You can start with the financial account profit. You can also start with the cost accounting profit. So in this case now, what we just need to do is to what? Do it the other way around. When we start with the cost accounting profit, we start with cost accounting profit balance of 61985. We add up all these different that we have here. We add everything that we have here up, okay? With the cost accounting profit. And what do we do now? We're going to what? Deduct this. Deduct. That is when we are what? We are starting with what the cost accounting profit. So this is how to treat this question. So I'm still gonna do more video in regards to interlocking an accounting system on how to reconcile, and also explain some other things that you also need to know when it comes to interlocking an integrated accounting system in cost accounting. Okay, so on this note, we're going to end it here. And please do not forget to subscribe to my YouTube channel, and also click on the notification bell so that you can be notified whenever I drop a new video. So this is how to solve the question. Kindly share the video with your friends and colleagues, and also send in your comments on this video if you find it very helpful. So thank you very much. God bless you, and see you in the next video. Bye bye.